And joining us now here on the program, we're going to talk about a new report from CoBank looking at the rising cost of grain storage and how that could force elevators to lower bids and widen basis. Here to explain the report with us, Tanner Ehmke, lead grains and oilseeds economist for CoBank. Tanner, great to have you on the program here today. Thanks for joining us. I hope all is well.
Thanks, Jesse. Thanks for having me on.
Well, let's dive in and talk about this report. And CoBank releasing this here just a few days ago, and I was very interested in this report. I thought it was fascinating. I think sometimes we don't think about elevators, and when they buy a producer's commodity, then they're putting it in their storage, et cetera, and how that could impact their bottom line. Just walk us through kind of the overview with this report. What made you guys look at this, and also what was maybe the key findings from this report here, Tanner?
Yeah, there was a lot that went into this report. We've been hearing within the grain trade for so long now about the operating cost, and this is a trading environment that we haven't seen for quite a long time. So if you look at last or the current marketing year prices, prices are historically high. For corn, wheat, and beans mainly. And USDA is expecting those prices in the new crop year to come down a touch. But historically, they're still fairly high. Now, at the same time, the Federal Reserve is raising interest rates. Okay, they've been on this path now. We're well aware of what's been going on there. The Fed trying to fight inflation by raising interest rates. Based on some of the news yet again here this morning on the jobs report, we may see yet another rate hike coming. So bottom line here, this is a collision of two things that really get a elevator where it hurts the most: high grain prices and high borrowing costs. And you add those two factors together, and the cost of storing commodities becomes very costly. They don't have a lot of control over that cost. To borrow money, I mean, the cost of money is what it is. We're a bank. We see these issues every day. We have these conversations every day about what the Federal Reserve is doing and what's the cost of funds and what's the cost of borrowing money. And so when you have high cost of money and high cost of commodities, and you're expected to store for a long period, these commodities for a long period of time, it's really going to raise your operating costs. And so how do you manage that? How do you manage these high costs? Well, like I said earlier, something like interest rates isn't something that you have a lot of control over. So what do? You're going to have to lower your costs by lowering your bid. And that's a situation that a lot of our customers are going to be in this next crop year. So our report is forecasting what we see as the cost of carry, or the cost of storing commodities on a monthly basis. We came out with a forecast that it's going to be up for corn, soybeans, and wheat for the year ahead across the board. For corn, we think the cost of carry is going to be up about 21%. For soybeans, about 42%. And then for wheat, it's going to be up about 50% year over year based on USDA's forecasted prices for the marketing year ahead. And then our forecast for the average borrowing rate is going to be about 7.75%. That's basically taking LIBOR plus about 270 or 225 or 2.25 on the spread there, 275 on the spread.
Mm-hmm.
And so play that forward, and what you have is a record high cost of carry.
Well, and thinking of that cost to carry, as you mentioned, being record high, and looking at this whole situation, I know that this can really get problematic for our cooperatives. You think about these volatile markets and managing margin calls and hedges and things like that. There's a lot that goes into us that really could tie up an elevator's working capital, so to speak. Here, Tanner, it's a very, very delicate situation. It feels like to me.
It's absolutely the issue that we pointed out in the paper, is that when your expenses are so high and you're spending more of you're spending more money on the inventory, that sucks up your working capital. You don't have as much funds for other operating expenses. You also have other things here, though, Jesse, that are contributing to it, to this rising operating cost environment for elevators. It's not just the cost of grains and oilseeds or rising interest rates. You also have a phenomenal leap in interest, or excuse me, in insurance premiums.
Hmm.
It's been a pretty phenomenal year. So that goes into it as well. Transportation costs, electricity and energy costs are going up, labor costs, you name it. All the things that we all deal with are going up, but especially insurance premiums are going up. And so they don't have a lot of control over these costs. The only thing they have control over is that local bid. And so, in order to cover those costs, they're going to widen that basis and drop that local bid.
Well, and if they drop that local bid, basis widens, of course, then that directly impacts our farmers and it impacts, what they're getting for their commodities. So it's kind of that trickle down effect, so to speak, Tanner. I know there's other, tools to manage your risk, et cetera, with the futures market, but obviously at the end of the day, lowering that bid has that direct impact. And I know that's something that probably has a lot of farmers concerned right now.
Yeah, absolutely. USDA, as I mentioned, is forecasting commodity prices to come down a touch next year. Now, I don't know how much of that is factoring in lower cash prices uh, based on widening the basis because of these higher operating costs. But I would imagine that USDA is probably going to continue to lower their projections on corn, wheat, and soybean prices, especially in this high cost environment. So I would imagine that would get dialed in. So on the other hand, you have farmers expected to harvest at this point in time record corn and soybean crops. So hopefully they can make up some of that lower price on yield. Uh, yield always pay higher yields almost always pay and make up for those lower prices. And so that is going to be very much dependent upon your location. You and I were talking before the show about the crop prospects right now. Yeah, it's a little concerning in some areas with this dryness, but going back to your local basis, yeah, it's going to depend on one elevator to another based on their debt structure, based on what their operating costs are, and what bushels they have to work with.
Well, I know as well, Tanner. And we've been talking. It feels like a lot of negativity around this. Is there any positive news on this report that maybe we can have as a little sliver of good news, a little bit of hope, so to speak? What's your thoughts, maybe on the positive side here, Tanner?
It depends upon who you are. Uh, One person's bad news is another person's good news. So I'd say perhaps the silver lining, if you can put it that way, would be if you're a local end user, if you're feeding cattle, if you're feeding hogs, if you're an ethanol plant, you might have an opportunity here to lock in some lower basis, and that's going to be a positive for those end users. Um, that's going to be a relief in an environment here over the last couple of years. We've had some very high feed costs, and so I think there's a positive story there. I think the story is yet to be told on what's going to happen globally. Okay, so we have currently a tight balance sheet globally on corn, wheat, and soybeans. What could materialize here is if the elevators widen their basis to cover their costs, that may attract some more export business back to the U.S. And what that might do then is you're going to have a stronger exporter bid, typically down at the Gulf for the PNW, that's going to lift that local basis back up again. It could provide a stronger support. That's all going to be excuse me. It's all going to be dependent upon how strong that exporter bid is, and that all really feeds back into what's going on in the global economy and the global balance sheet on corn, wheat, and soybeans. So there could be an opportunity here where that local bid brings in more export business, and that firms up that your local basis.
Well, all great thoughts. And you mentioned just that global outlook for the economy and the balance sheets. And we think about the US balance sheets as well, and just the volatility that's been in the futures market as of late. I just want to wrap up real quick. I know we've come down quite a bit. We've seen a little bit of a gain back here this week in the grains, but your general thoughts in this grain and oilseed trade here as we roll into the month of June. Any other things kind of stand out to you that you want to keep an eye on right now, Tanner?
Well, for corn, I'm looking at what's going on down in Brazil. They've got some pretty weak basis down there, and that's obviously been holding us down on corn. That's attracted a lot of export business away from the U.S., thus all the Chinese cancellations we've seen recently. But I think there's the weather scare here right now. It's getting a little crispy across the Midwest, a little bit drier than what the market is than what the market is comfortable with. We got some forecasts for rains, and so I think that we'll see where that goes. We're not, we're just now getting into the month of June. We need to get another week or so underneath our belt before we start getting a little too concerned about crop conditions, since we've just got the crop in the ground. On beans, kind of the same thing there. We've got, it's very early in the season yet. The market is going to be trading these weather reports, and so again, Brazil has been very strong in their exports. And so that's what's held us down over the last several weeks now with their record soybean crop and now their record corn crop. Wheat is a whole other animal. We've got so many things going on there with wheat, with a small HRW crop on the plains, a very large soft wheat crop coming in the Corn Belt region. And we'll see what happens with the spring wheat crop that's just now getting planted. But I think we've got a lot of spring wheat based on what's the stats Can said about the Canadian spring wheat crop, a bigger spring wheat crop coming from Canada. And so that's going to depress your protein values. But the eyes really right now are on Kansas when it comes to wheat. The wheat tour had a very small forecast, I think about 174 million bushels. And that is a very small Kansas crop. And this would be the smallest crop since the 1950s. And so I think the market is still trying to figure out what's going to happen there with wheat. We've still got a couple of weeks yet to go before combines are rolling. And we're going to find out not only just the size, but the quality of the crop as well. Quality is going to be key for this year's wheat crop, which is why we had those imports of hard wheat from Poland here recently. It's all about quality. And that was some low protein wheat. Low protein hard wheat. And that's one thing we're short of this year. It's going to be a high protein wheat crop. And so the market is grasping for that low protein. And it's really an odd year. It's not something you typically see. There's always those protein premiums. And this year it may be, in fact, protein discounts. So a bizarre year for wheat.
Yeah, great things to think about and consider, and we appreciate the time. And if folks want to read the full report, rising cost of carry will force co-op grain elevators to lower bids and widen basis. You could find it on the CoBank website, cobank.com, under their Knowledge Exchange tab. You can also find the links on our website as well. With that, Tanner Ehmke, lead grains and oilseeds economist with CoBank. Thanks for the time here today. We'll talk to you again real soon.
Thanks for having me, Jesse.